Nowadays, with the stock market going crazy and a bunch of stocks in various industries such as oil, financial services, airline, and travel, with those stocks down 50% or more from their highs, there's a lot of renewed interest in investing. And with good reason. Opportunities like this don't come around often. If you've been too scared or cautious to invest up till now, starting to invest during a recession or during a stock market crash is every investor's dream. Unfortunately, it's not quite as easy as saying just buy all the stocks, just buy all of them because everything is cheap. Because like with everything that's worth doing in life, investing is a lot easier said than done. There's still a lot of uncertainty in the coming months, and of course, emotions can get in the way too. That's why in this video, I wanted to go over the top 7 investing mistakes that beginners make. Because yes, a stock market crash is a golden opportunity, possibly once in a lifetime chance to buy investments on sale. However, that doesn't mean you can just throw all caution out the window and forget about the tried and true principles of good investing. There is going to be a lot of volatility in the stock market in the coming months. So as you put together your investing game plan for the coming days, weeks, and months, here are the top beginner investing mistakes to avoid. Number 1. By far, the most common mistake I see beginner investors make is not even investing at all. So I get it. It feels a lot safer to keep your money in a bank account instead of investing it. Cash in the bank just gives you this sense of financial and emotional security like nothing else can. In fact, you should always keep some cash in the bank. Cash to cover you in the event of an emergency, and cash that provides a buffer so you don't have to sell your investments during a market crash just to pay your bills. However, there are lots and lots of people who keep all of their life savings in cash, possibly for their whole life. This is a huge mistake, and quite frankly, it's a recipe for becoming a bag lady in your old age. Or a bag man if you're a man. The reason why keeping all your money in a bank account is such a bad idea is because of inflation. Due to inflation, cash steadily loses its purchasing power at a rate of roughly 2% per year. That means over the next 30 years, uninvested cash will lose more than half of its value, just because of inflation. According to this chart from the Federal Reserve, the dollar has already lost half of its purchasing power just in my lifetime. Which means if I have the same amount of money as I do now as I did back then, everything is twice as expensive for me. Imagine everything being twice as expensive when you are older and retired. Cash in the bank provides the illusion of safety. However, if your money isn't growing at a rate faster than 2% to outpace inflation, you're not even standing still. You're actually falling behind. It's like trying to go up on a down escalator. That's why just saving money in a bank account isn't going to cut it. You have to save your money and then invest it. It is the only shot you have at beating inflation. Yes, there are a lot of emotional hurdles to overcome in order to start investing. The volatility in the stock market, it's not exactly a walk in the park. With the huge recent drop in stock markets, my investments are a bloodbath and it's not fun. However, I am willing to put up with the ups and downs and hold on because I know that the alternative isn't a viable option either. It's either to let inflation destroy my savings because I'm keeping it in a bank account, or put up with the stock market volatility in order to give my money a chance to grow. So I choose the second option. If you've never invested before, it is gonna feel scary to pull the trigger. No matter what the market is doing, even when the market was doing really well, it was scary, and now it's still scary. So the emotional experience of risking your hard-earned money is never gonna go away. So I want you to stop making excuses, stop procrastinating making decisions, and stop putting off what you know you need to do. Make a plan, do your research, and get invested. Moving right along to beginner investing mistake number 2, which is not having an emergency fund before you start investing. It's really important to build up a reserve of cash that you can tap into whenever you get hit with an emergency expense. For example, your car breaks down, you need to get it fixed, you get sick and you need to take off work a couple months, you get laid off. This kind of stuff happens, and that is just life. And the last thing you want to do is to have to sell your investments early just to come up with some cash to cover these emergency expenses. Or worse, the last thing you want to do is go into debt as well. That's why an emergency fund is so important. Back when I was in middle school, 9/11 happened and the economy obviously took a huge hit after that terrorist attack. and the company that my dad worked for at the time shut down, so he didn't have a job for a while. Our family went a couple months without any income, and I remember it being a super stressful time, as you can imagine. And my parents didn't have an emergency fund, so they ended up having to tap into my sister and I's college investment fund in order to pay for our living expenses. Although I was too young to remember all the details, I'm pretty sure those investments lost money because after 9/11, it was a really bad time in the stock market to sell. So the end result, we didn't have a college fund. So this tip comes from real life personal experience. Please don't take it lightly. You need to have an emergency fund before you try to start investing. Don't try to run before you can walk. Otherwise, you risk having to sell your investments at the lowest point in the market and depleting everything you worked so hard to accumulate. The stock market is extremely volatile from month to month, as you know. So if you invest $1,000 today, then I'm sorry to say there's a good chance that $1,000 will be $800 next month. And then the following month, that $800 might go back up to $1,200. That's just how the stock market behaves. It yo-yos a lot in the short run, but in the long run, the stock market follows an upward trajectory. Just look at this chart of the S&P 500. In the later part of 2015, there was a lot of volatility. In 1 month, up 8% in October, and then down 5% only 3 months later. But then you zoom out to the longer term perspective up to 2020, 5 years later, and we're way up here now. That's why you should only invest in the stock market with money that you absolutely don't need to touch for at least 10 years. Like it's money that you do not need no matter what happens because you've got cash cushion in other places. You can't look at your investments like an ATM machine where you can just freely take money in and out whenever you need some extra cash. Now, if you're wondering how big of an emergency fund you need before you can start investing, $1,000 makes a good starter emergency fund. Once you have a starter emergency fund of at least $1,000, ideally more, then you can start investing. Over time, you want to build up an emergency fund that is big enough to cover you for at least 3 to 6 months worth of living expenses. The next beginner investing mistake I see a lot of people make is waiting too long to start investing. Once you have an emergency fund, and of course I'm also assuming you don't have a bunch of credit card debt weighing you down, then you are ready to start investing. However, I often see a lot of beginner investors just getting ready to get ready. As I mentioned before, I know it's scary to start investing for the first time, but at some point you just have to pull the trigger. You can wait and wait until it's the perfect time in the market to get in, but there's actually never going to be a perfect time. Theoretically, the best time to get into the market is at the very bottom of a crash. But the thing is, how will you know it's the bottom? No one knows when the market has bottomed out until after we've passed it, until it's basically too late. As the saying goes, hindsight is 20/20. Now, if a cure and a vaccine for coronavirus gets invented like tomorrow, the market might come right back up to where it used to be, and if you were waiting and waiting for that perfect bottom of the market time to buy, then you would have missed out. And then on the other hand, this pandemic could drag on for years and the market could go down a lot more from here as well. It's just that nobody knows. So at this point, both scenarios are completely plausible. That's why I don't want you to waste any time and energy trying to time the market. If you are a long-term investor, timing the market is not a really good use of your time. I know it's tempting to try to pick the market tops and market bottoms so that you make perfect decisions and never have to experience watching your portfolio go down, but that approach is going to have you waiting for a really long time. And even if you had a crystal ball and somehow you did know exactly when we reached the market bottom, when that moment arrives, would you be brave enough to buy? I mean, market crashes are stressful and scary already, and even the most experienced investors are panicking and selling, let alone buying. Everything is 10 times scarier during a market crash. So as a brand new investor who's never bought any investments before, the chances that you'll have the discipline to buy right then and there are quite slim. I'm just being honest with you. So don't wait too long to start investing. If your financial situation is reasonably stable, you're ready now, so set a date to start and stick to it. Now, I'm not saying you should set a date and invest all your life savings into the market at once, because that's not exactly a great idea either. Which brings me to beginner investing mistake number 4, investing too much money at once. If you're brand new at investing, it's a good idea to practice investing with smaller amounts of money until your nerves get more used to the market volatility. Watching a $100 investment go up and down with the market is a very different feeling from watching your $100,000 investment, which is all your life savings, go up and down with the market. So again, don't try to run before you can walk. Start investing with $100 or whatever amount feels comfortable to you and see how that feels. So decide on a starter amount that you're comfortable with, and then if you can tolerate that and you're not lying in bed awake at night stressed about it, then you're ready to start investing more amounts of money. If you feel comfortable with having 1,000 in the market, then you're ready to invest more. And then just keep ramping up from there. If you try to invest too much all at once, it's going to be a little bit of a shock to your system, and then you might end up doing something stupid like panic selling after a drop in the market because you weren't expecting that, and that kind of thing has permanent consequences. Panic selling is never a good idea, and selling after a crash is also never a good idea. And unfortunately, because they weren't prepared for the emotional ups and downs, that's something that a lot of beginner investors tend to do. So the key is to start investing with a small amount of money that feels comfortable to you, and then to ramp up from there. Okay, so we talked about how it's good to start small in order to train your nerves, but eventually you do have to start being aggressive about investing more, because the next beginner investing mistake is actually not investing enough money to cover your financial needs in the future. According to a study by the Schwartz Center for Economic Policy Analysis, 40% of Americans will fall into poverty or near poverty in retirement. Look, I don't want to scare you, but I don't want you to become a statistic either. Here's some real talk about how much you should have saved up when you retire. Let's say you want to retire in 15 years. Whether that is early retirement or you're retiring at age 65, let's just say you want to retire 15 years from now. Let's also say, just for explanation purposes, that you want $50,000 a year to live off of when you retire. When you factor in inflation, then a $50,000 a year lifestyle 15 years from now is actually going to be more like a $67,000 lifestyle. Which means in order to retire 15 years from now and have the income and lifestyle that you want, you need to have a nest egg that's going to be generating $67,000 a year for you in retirement income. So how big does that nest egg have to be? Well, according to the 4% rule, in order to have $67,000 a year in retirement income, your nest egg would need to be roughly $1.7 million. The 4% rule is a simple calculation that estimates how much you need to have saved in order to retire and to be able to withdraw in retirement without running out of money before you die. Basically, you just take your desired income level in retirement, so in our example it was $67,000, and you divide that by 4%. That gives you $1.7 million. Another way to calculate this is to take your desired income in retirement and multiply that by 25. It's just a different way of calculating the same thing. And this rule is called either the rule of the 4% rule or the rule of 25. Feel free to look it up. It's really interesting. So I know $1.7 million is a lot of money. And in reality, probably 1 million or less is going to be enough, because I'm guessing you're going to have other sources of income in retirement, like part-time work and maybe even Social Security if it's still around in the future. So to get to a $1 million nest egg in 15 years, you need to invest at least $2,700 a month for the next 15 years. Now, if you want to take 30 years to do it, in order to have $1 million in 30 years, you would need to invest at least $500 a month for the next 30 years. So investing a couple bucks here and there isn't going to be enough. Recently, investing apps like Acorns and Stash, they've become quite popular because these apps let you link up your debit cards and credit cards, and then they'll round up every purchase you make and invest the spare change. And while I think apps like these are really great for starting out and proving to yourself that you can actually save money, these roundup investments of a couple cents here, a couple bucks there is really not going to cut it. Aim to invest at least $500 a month at a minimum and put it into a tax-free retirement account like a Roth IRA. And that is a perfect segue into the next beginner investing mistake, which is not investing with taxes in mind. Taxes are going to be your single biggest expense in your lifetime, so it makes sense to try and minimize your tax bill as much as possible. The best way to do this is by investing with the right accounts. Now, just by investing in the right type of account, like a tax-free account, like the Roth IRA, you will save so much money on taxes. Typically, whenever you invest, you have to pay income taxes on dividends and interest payments, plus you have to pay capital gains taxes on any profits on your investments. So with tax rates ranging from 20 to 40%, taxes will take a huge bite out of the money you actually get to keep and spend for yourself from your investments. So just by investing within a Roth IRA or other tax-free, tax-advantaged account, you're giving yourself a 20 to 40% head start. Robinhood is an investing app that has become super popular with millennials, and I get asked a lot about it. And I think they did a great job marketing their platform because lots of newbie investors have signed up and started buying stocks there. But the problem is Robinhood doesn't offer IRAs and Roth IRAs. They don't offer any tax-advantaged accounts, at least not as of today, April 7th. And if you're a brand new investor, you really have no business starting off with a taxable Robinhood brokerage account if you don't even have a Roth IRA first. You're really selling yourself short and you're going to end up paying too much in taxes. If you're just starting out, start with a Roth IRA and do it at a well-established company like Fidelity or Vanguard. There's a lot of different companies out there. There are also many other types of tax-advantaged accounts other than Roth IRAs, such as traditional IRAs. There's also 401ks and HSAs. If you want a complete rundown of the different types of tax-advantaged accounts that are available to you as a beginner, check out my ultimate guide to brokerage accounts. It tells you the pros and cons of each type of account, as well as exactly where to open them. The download link is below, so grab it if you're interested. Just ask any seasoned or professional investor. To them, taxes are always a huge factor in what they invest in, also in what accounts they use to invest in, and when they buy or sell their investments. Yes, if it weren't for taxes, we would all have way more money, but unfortunately, taxes are unavoidable, so the next best option is to invest in a tax-savvy manner by using the right brokerage accounts. Last but not least, beginner investing mistake number 7 is not being honest with yourself about how hands-on you want to be with your investments. There's a lot of different ways to invest, and they each require varying levels of time, knowledge, and effort. The easiest way to invest is to just buy some good low-cost index funds according to a good asset allocation and put it all on autopilot. Set it and forget it. You can expect to make anywhere from a 7 to 10% annual return investing in low-cost index funds. Another way to do it is by investing in individual stocks in just a handful of companies that you believe in. If you do good research and you pick your stocks well, you can expect to make even higher returns than with index funds. 20, 30, 40, 300% returns, the sky's the limit. But it's also not an easy task to read through company annual reports. It's not easy to look through financial statements, crunch the numbers, and think about whether one stock is a good investment or not. All of this takes work, and there's definitely a learning curve. 90% of people aren't really interested enough or even have the time to do this kind of investing. So the key is you gotta find an investing style and a rhythm that works for you. I used to be all about researching and investing in individual companies, and I spent a lot of time doing it. But for the last year and a half, I've really scaled back on that because I've been super busy with other things like starting this YouTube channel and getting married and moving and just getting other projects off the ground. And because I'd rather be invested than not invested, I've mostly just been in index funds for the last couple years. That's just me being honest with myself about how much time I'm willing and able to allocate towards investing. And that is changing a bit now. I have more time on my hands with social distancing and I have been looking more into stocks. But for you, take a moment to think about what style of investing and time commitment works best for you. And then do it. If you want a set it and forget it approach, go with index funds. If you want even more of a hands-off approach, hire a robo-advisor or hire a financial advisor to do all of it for you, to even put together the initial portfolio for you. If you really want to be more hands-on and put in the work for the chance at making higher returns, then learn how to research stocks and go for that. Regardless of which route you go, it's better to invest than to not invest. In fact, it's not even really an option to not invest, because if you want to have a shot at a secure financial future and beat inflation, you're going to have to get on board at some point. So better to do it sooner rather than later and find an approach that works for you. So that's it for my top 7 beginner investing mistakes. Now, I am no saint. I have made all these mistakes myself, so I'm just sharing these from personal experience. And I hope that it's given you a good idea of the pitfalls to avoid. And more importantly, I hope this video has inspired you to take action on your financial dreams. Thank you so much for watching. I appreciate you. And if you liked this video, please give it a thumbs up and subscribe to my channel. I post new money and investing videos every Wednesday. So I'll see you next week, same time, same place. Bye.